Hello and welcome back to another episode of the Mark Moss Show, where we talk about the decentralized revolution, of course, the way the world is changing as we look at it through the lens of politics, finance, and technology. You know, I try to bring a bunch of different perspectives for you so you could learn to understand these issues from a bunch of different angles. And I'll try to bring to you some people that, know some of these issues better than I do. And that's exactly what we have today. I'm in studio with Rob Simone. He works with Hedgeye REITs, which, of course, are real estate investment trusts. He knows a couple things about this. And, of course, as we're talking about the problems in the economy, the problems in the mortgage-backed securities, specifically commercial mortgage-backed securities market, and REITs as well, I thought, man, who better to have Rob than Rob on? So, Rob, thanks for joining me today.
Thanks a lot for having me, Mark. Yeah, I mean, like you said, I work at Hedgeye. I cover real estate investment trusts, which are basically, publicly traded companies that own real estate. And so the issues that everyone's reading about kind of like directly and tangentially touches my space. So have to kind of, keep on top of it. But it's a much, it's interesting. It's a much broader kind of, I guess you could say, like concern or consideration outside of just REITs. But yeah, it's a fascinating topic these days for sure.
Yeah, I mean, it's certainly touching every area of the world. I mean, it's money, so it's half of every single transaction that we do. I know I've covered quite a bit, the problems that happened in the banking crisis with Silicon Valley Bank and the other banks as well. And kind of they got caught up in this kind of mismatch of duration, seemingly. What they did is they took customer deposits and put them into these very risky assets, not altcoins, but treasuries. And when the treasuries lost money, then they got hammered. Now, of course, the treasury, every time you think their back is against the wall, they seem to pull another magic trick or another special facility out, BTFP this time. And now I've been looking at what's going on in the commercial space. So, I mean, first of all, you deal with REITs. Break that down for us. What
sure.
REITs
Well, it's a big topic. So there are two kinds of REITs, and again, those are real estate investment trusts. I tend to focus on what are called the equity REITs, and those are the companies that actually take ownership stakes in assets, but across multiple different property sectors. So like sometimes, people will say, oh, commercial real estate or real estate as like one kind of catch-all term, but in reality, it's a very like broad, deep, and diverse universe. So within the the REIT world, there are multifamily or apartment REITs, retail, office, industrial, and logistics. Those are kind of like the main food groups, so to speak, of traditional real estate. And then beyond that, you'll have things like a little more creative, like self-storage, cell phone towers, data centers, something called triple net, which we can get into. So those would be like the property owners. And then on the other side, a much smaller universe of what are called MREITs. And MREITs actually make debt investments, so they originate mortgages or loans, whether they be like bridge loans or whatever, against real estate. The purpose is, or like the real point is that like REITs are supposed to be investors in property, whether it be equity or debt. So they kind of split the world in half, and the much bigger universe is the equity REITs that actually own properties.
You make a good point there that I just want to hammer on just a little bit. It's something I talk about. There is no such thing as the real estate market. Mm-hmm. Thousands of markets. And not only are they broken up by different types, so obviously a big category would be single family versus commercial properties. And then, of course, Rob, you broke down the different types of commercial properties. But then even within those categories, then you have other things like size and location, specifically. And then even within that, potentially even what types of use cases they have. So, for example, commercial that does office space in San Francisco is way different than commercial that does data centers in a cheap energy state or something like that, right?
Yeah, for sure. And I used to work at an office REIT called Paramount Group that owns office buildings in Manhattan and San Francisco. And you kind of hit on it. So like in general, I think for better or for worse, and this isn't just REITs, these are kind of like all property owners, unless you really get into like major scale, like a Brookfield or maybe like a Boston Properties or something along those lines. Or if you're like a big fund investor that owns assets kind of scattered to the wind all over the place. But these private and public owners of real estate, including the REITs, they tend to focus on a couple of markets and like know them really well, as opposed to like spreading themselves too thin. And so it's not uncommon to see like a REIT focus on one property sector and then kind of circle a couple of markets and then really learn them intimately, understand like all the different constituencies and the players in that market, so that it like at least theoretically gives you, or it should give you, an edge over less experienced investors. Now, that obviously it doesn't always play out, and we've seen that episodically, and fortunately in my space, or depending on whether you're long or short, there haven't been any like major REIT blowups yet. But we saw it in the last cycle. If I had to kind of like think about some of the sectors that got into some real trouble with too much leverage in the great financial crisis, it would be office and lodging. I forgot the hotel REITs, by the way. So like some REITs own hotels as well. This time around, there's like less leverage in general, but one sector that's very, very highly levered is office. And part of it's because of like absolute levels of debt, but also it's just like poor operating performance, whether it be tenant move outs or firms, like they call it consolidating space. And that's where you, like as a tenant, maybe like, 5-10 years ago, you thought about 175 to 200 square feet per employee. But along the way, whether it be like through co-working or like, moving some of your folks out of the office and letting them work remotely, suddenly you only need 150 square feet per employee. And now what does that mean? To the landlord, it means that all else the same, each tenant takes less space. So it's harder to lease up a building. The economics are worse. You have to put like more CapEx into it, give tenants more concessions and whatnot, and all else the same, if you have like a mortgage on that asset, right, and you thought it was like maybe 50 or 60% of the value of the building 6 or 7 years ago, today, like because of what I just described, it may be 80% or higher. So it's kind of like a slow moving train wreck, and you're starting to see some of the owners default and give the keys back on some of these assets. Like we just saw Brookfield default on a four building portfolio yesterday, just as an example.
Yeah, that was a big news.
Yeah.
So out of these different types of REITs that you're kind of breaking down, everything from retail to business, office space, data centers, et cetera, hotels, et cetera, I guess I saw in the commercial mortgage-backed security market, it looks like that's like another big bomb that potentially could be blowing up inside the banking sector. I believe it's almost $3 trillion, $2.9 trillion worth of commercial mortgage-backed securities, of which I saw about 20% of that seems to be non-payers. I don't know if that's specifically in the office space commercial sector. Do you have any data on that, or info on that data?
Well, it's a little more opaque, and to be honest, like from and this isn't dodging the question. Actually, it may be informative for folks, and it may help people dodge some bullets investment wise. And I guess like as an analyst, that's kind of my goal primarily. In my
Rob,
corner
before
of the
you
world, yeah, sure.
Oh, shoot.
No, it's all good.
Hang on. Before you drop that piece of knowledge for us, I'm going to take a quick break. Rob, I cut you off before we had to take a quick break, but you were saying some ways that we could kind of look at this.
Yeah, sure. So it's interesting. In my corner of the world, most of the REITs, they prefer to be what are called unsecured borrowers. So what they do is, and the reason why I'm bringing this up is it's an interesting way of at least like mitigating one of the risks, maybe default risk or the direct impact of an owner defaulting and like the equity going to zero, right? So like REITs tend to be what are called unsecured borrowers. So they'll basically issue bonds at the corporate level to partially finance themselves. and then use those proceeds plus their equity to make investments in assets. It's a little less common for buildings, unless it's like a smaller company, to have mortgages on them. And the reason why I bring that up is it's the mortgages, the individual asset loans, or loans that are secured by a specific asset that get put into CMBS. The private borrowers tend to use that kind of financing in the debt markets, and so it has a couple of impacts. Like, one, it leaves the REITs like kind of isolated, and so it's a decent place to play if you want to mitigate your risk. But it also, as an analyst, it makes it a little tougher to analyze because the private borrowers are not as forthcoming with their data as like some of the publicly traded companies. Now, with that said, there's like plenty of data around like the different CMBS indices. So a couple of years ago, I believe it was what's called CMBX 5 or 6, and it was a majority or like a pretty big slug of the loans that make up that index were collateralized by malls. The new flavor of the week, I think it might be 6 or 7. It's like CMBX 6 or 7. You can look it up on a Bloomberg terminal. It tracks the performance and pricing of loans that are like major. Well, maybe not majority, but like there's a big slug of office in there. And office is where the most stress is. So like what I would do if like for your listeners is, if you're looking to like kind of ring fence that or avoid any like big blowups, focus on like the lower levered REITs that don't have individual property mortgages, or if you wanted to take advantage of it, track the indices that have high concentrations of office loans. What's really, really opaque, and like if anyone told you they knew the answer to this, I think they would be lying to you. Like even our financials analyst, our bank analyst, Josh Steiner, I think he would tell you like he's not quite sure exactly how to answer the question, just that there's an issue, is like where the individual loans that haven't been securitized in these big CMBSs sit on the bank balance sheets and what that means. And like my theory is, where the pain is going to show up is on the financials and on the bank earnings when they have to take credit loss positions, as opposed credit loss charges, as opposed to like the big publicly traded REITs. Like that's where I think you're going to see like a real mess. Just a theory, but.
So is that sort of like in the great financial crisis in 2008 was sort of a similar situation, but it was in the retail space, in the residential mortgage space, and it was also commercial mortgage-backed securities, and they were sort of combined into this mortgage-backed security sausage, so to speak, where then there wasn't really any visibility into what these tranches were and what the risk levels were within that. So is that kind of what you're saying? In a similar way, you kind of have all this that's kind of been mashed together, and there's really no way to kind of assess the risk?
That's exactly what I'm saying. And in many ways, it's gotten even tougher because coming out of the GFC, the banks under tighter capital rules and like having to hold additional equity capital, and also individual pieces of the tranching on a risk basis. So like what I mean is if you originated a CMBS, you would have to, as the issuer, as the sponsor, you'd have to retain the equity slice. Banks, all else the same, don't want to do that because it requires them to tie up more of their equity, i.e. like not loan it out and earn a spread. So it's costly to them. And so what's happened is you've had the rise of these like what are called non-bank or shadow lenders. By the way, the mortgage REITs are part of that bucket. So they're like they're not part of the Federal Reserve System. They're not as tightly regulated. They're more like, by the way, they're more free market vehicles. It's the kind of situation where, like, if you're a shareholder of a mortgage REIT and you don't really have a good sense of the types of risks or funding that the REITs are utilizing and taking, you bear the consequences of that. It's like it's kind of more libertarian, I guess you could say. But the byproduct of that is it's become more opaque and less easy to see or find.
So I think that's the problem. Without that visibility or transparency, it's a problem for the banks. They don't really understand their risk levels that they have there. But we do know some of the risks, so that kind of goes back to potentially this $2.9 trillion in commercial mortgage paper. of which about 20% of it seems to be non-paying delinquent.
Yeah, that's right.
And about 50% of it has to be refinanced or rolled over in the next 24 months, it looks like, at what appears to be going to be much higher interest rates.
Can I tell you a story about one of the
Please.
things that we're hearing? So over, where I'm most worried, and this may be like kind of surprising to folks, is on the multifamily side, on the apartment side.
Okay.
So
Would you
obviously,
consider that anything above 4, or are you typically thinking like in the hundreds?
Sorry,
Anything
what was the
over
question?
anything over 4 units, technically multifamily,
Yes.
or are you thinking typically in like apartments like hundreds of units?
I'd say like north of 4. Like, so I'm thinking like Class C apartments where you start getting into like the 30, 40, 50 unit buildings and above.
Okay.
But what happened was, obviously, like everyone, I'm sure the listeners of your show and like we've talked about it a lot, and it was very topical over the last 2.5 years, just kind of like the rise, like both on an absolute level, but from a rate of change perspective and how rents have changed, right? Apartment rents, particularly in the Sun Belt.
Yep.
And so at the same time, which was somewhat unique, interest rates were at kind of generational lows, right? So you had trough interest rates, trough cap rates, which we can get into that, but a cap rate is just a methodology for valuing a building, essentially. It's the inverse of value, right? So lower the cap rate, higher the value. You had all these borrowers, like what are called sponsors. So think like private developers, private owners running around, taking advantage of really cheap financing to buy assets at like very, very high prices and low cap rates. And in many cases, they use what are called transitional loans. So like 2 to 3 year bridge loans that obviously at maturity, you have to roll those, right? They're called rolling it and industry parlance or refinancing it. Well, what happened?
I'm gonna have to put you on hold there, Rob, and leave everybody on a cliffhanger. What did happen? Because I want to know. I'm suspecting it's a big problem that's there. I know these bridge loans have to be kind of rolled over to the point we're making. Rob, you were just explaining before the break all these short-term bridge loans, sometimes 2-3 bridge loans that might have been piled up, and maybe what potential problems could be.
Yeah, definitely. So, like, imagine. Well, let's put it in practical terms. Like, imagine you bought a house, and you bought it in the second quarter of 21, and you bought it with like a 2-year loan, right? And your plan was to rent it out, and you at that point, or like anybody else that could kind of see like rents flying off the page, thought that like at a sub 3% interest rate, that by the way, these are floating loans, right? So they're not fixed at rate, they float with the market. You thought you were getting a 3% cost of financing, and that like over the next 3 years, rents were gonna grow 15% per year. And the bet you were making was that like you could pay a really high price or a low cap rate, earn that growth on your rents, and then on the back end of it, refinance it at a much higher value, right? So that was the bet that a lot of these guys were making.
Well, it's
And
been
what
the
they were
game that's been
doing,
working for a long time.
it's been working for a really long time, but in this case, because the debt markets were so open, a lot of these guys used like 90% plus, or like think of the inverse. They only put like 5 to 10% equity in. So the LTV on a lot of these loans is 80% or higher. Now, what happened between now and then, right? Like inflation obviously soared. Fed came in, jacked up rates faster than like any of us have ever seen, at least in our lifetimes, right? Rent growth slowed. So like if you thought you were getting 15% NOI growth per year, or like rent growth per year, maybe that turned into 8% compounded. And at the same time, your cost of borrowing went from 2 to 7. So when you go into the permanent financing market, suddenly the math doesn't work anymore, and you could only, finance maybe 60 to 65% of the value. And oh, by the way, the value came down 35%. Yep. So like a lot of these guys, and I know you get it, but like practically speaking, like what this really means for folks is that everyone's underwater. And so a lot of these guys are running around trying to like basically get another 2 to 3 year bridge loan to get them to the other side, making the bet that the Fed's going to have to cut rates and they'll be able to live, like basically live to fight another day. And we at Hedgeye, like we're kind of we're very rate of change focused, but like we also think that we're going to be higher for longer, pretty clearly, and that the Fed, every time the market rips the way it has, the Fed is more incented to like keep rates higher for longer. So that it makes that like ability to kick the can a lot tougher for these guys. And I'm seeing it, and we're seeing it like with one of the REITs that I cover called Arbor. ABR, it's a mortgage REIT. They only do these like 2 and 3 year bridge loans for apartment sponsors. Basically, they're already seeing, guys literally just give the keys back and like maybe flee the country because they're just like they put 5% equity in and they're underwater and it's like, you know what, we lost this one, we're out, and then the lender's stuck with the keys. So it's messy, and then like those impairments, what's going to happen is those losses are going to start showing up, I think, over the next like quarter or two on not just the banks, but like these, shadow lenders' balance sheets, and their earnings are going to be bad. They're probably going to have to raise equity in some cases to like, basically have a capital buffer and still be able to lend out, right? It's a really tough situation, I think.
And the other big thing on that is not only obviously the problems that you've already talked about. So you have multiple kind of attacks, if you will. So one, you have potentially people not buying. Two, you have this loan that has to be rolled over that now you can't afford at the new rate. But then on top of it, you have, because this problem has been created by the Fed raising rates so much, people that were buying buildings at a 3, 4, 5% cap rate don't want to buy it at a 3, 4, 5% cap rate anymore when I can go make 5% just sitting at the Fed.
That's right. That's right.
So now they've drained away liquidity from the market.
Yeah. And by the way, like it's actually a lot scarier than that. So some of these deals that I've been looking at were done at like 2.5% cap rates in the first and second quarter of 21. I mean, that's a tremendous amount of risk. And they levered themselves up 80%. It just, the math doesn't work. And you're right? Like you and I may like hate monetary policy the way it's run, and I think you and I I'm guessing we probably see eye to eye on that. But like the reality is, you basically have, on a nominal basis, you have a risk free bet at 5% right now. So why take the other side of that?
Yeah, it makes no sense, and that creates even more problems. So there's two potential things here that I want to talk about and see if we can speculate on to potentially what could happen from this. And so one is like obviously all this debt that could potentially go bad. People just hand the keys over, they're walking away, and that just kind of rolls up to whatever bank's holding that paper or whatever REIT or wherever that is. So there's a big problem there. Now, it seems like what I would expect after seeing what happened with these new facilities the Fed put in, with the BTFP, et cetera, is probably something going back to like what we saw in 2008, where maybe the Fed just says, give me all your mortgage-backed securities, I'll just give you back to par. So maybe all these commercial mortgage-backed securities that are sitting there, whatever, 2.9 trillion, they need to be rolled over, and there's this big debt bomb that's sitting there that a lot of people are warning about. Potentially the Fed could just be like, okay, like we see the problem there, we don't want the system to collapse, we'll just put them on our books, we'll give you back at par.
It's possible. I mean, I think.
If not, we end up in a 2008 meltdown scenario, right?
Yeah. I think. So I'm just guessing here, but
we're all guessing here. Just for everyone listening, we're all guessing.
We're all guessing. It has to get a lot worse from here. So if you recall last time around, and I'm just thinking about this through the lens of commercial real estate, not resi. What was happening was you were kind of like some of the, like, let's talk about lodging. Like, so the hotel sector got very over levered going into the GFC from a commercial, like on the commercial real estate side. And what happened was a couple of borrowers or sponsors started running into trouble, and they started kicking back assets like onesies and twosies back to the banks, and the banks were taking the keys. But then what happened was things got real, and everybody was defaulting together, and suddenly the bank said, hey, time out. Like, we don't want to, but we actually cannot take all of this back at once because we'll have to raise too much equity. And that's when the market, like, and you and I saw it, like the days where all the banks were dropping 20, 30% per day, started pricing in the banks having, if they were able to survive at all, having to do these big giant equity raises, right? Because they would have to raise equity to hold against the assets that they take back in lieu of like a loan. Because again, banks aren't in the business of owning real estate; they're in the business of making loans. Right. And so my thought is like, before we get there, like it's got to get a lot worse, and the Fed's either going to do what you said, or they're going to do like some form of capital injections into the banks if it got that bad, similar to last time, to give the banks basically cushion to absorb those losses. But yeah, I mean it's a logical conclusion, right? Like I don't think the private markets would be too keen on recapping the banks, given that there's a backstop, right? So
yeah. Well, I guess, and just kind of in that thought exercise, kind of going back to some of these takes where Elon Musk says commercial real estate is by far the most serious looming issue, right? And like I said, you look at it looks like a lot of the smaller tier banks are the ones sitting on this paper, and they're the ones that are most vulnerable. And so, like, while it looks like it could bring the whole house of cards down, it seems like the Fed would probably step in and bail out the house of cards before it all came down. To your point that you're making, though, I think it has to get a lot worse. So I want to ask you about that, and then I want to find out what you think, kind of what your idea forecast is. Are we going to see a big sale coming up, or is this a time to really tread carefully? So what does that look like getting worse? Lots of defaults. The banks are now taking these back. They're not in a dangerous enough situation yet where the Fed has to intervene, but maybe the bank has to do something, so they're starting to fire sell these things off, getting some kind of creative deals going.
Yeah. So, like, to be clear, I think you're, you kind of hit on it. So, we at Hedgeye, we're very macro focused. We kind of like start with the macro, and then it's my job to pick stocks underneath that, depending on like where we are in the cycle. And our thought is that, and our macro team's thought is that we're in the middle of maybe like one of the most challenging macro environments since you or I could remember, right? Like, so the
last 100 years probably.
Yeah, like not to get too alarmist, but like we think it's pretty bad, and it's getting worse at a significantly faster rate. Our founder Keith, he thinks we're in the middle of what's called a credit event. Now, what does that mean? A credit event basically means like a cascading default cycle, and how does that express itself? Like, what should people look for? So, usually, one thing that's really interesting right now is the bond market and the equity market, so the stock market, are sending two very different messages. The bond market is, whether it be like the government or corporate bond market, is basically like battening down the hatches, preparing for the storm, where the equity market is kind of ripping higher or bouncing higher. We think it's actually being forced that way by people who need to get out, like some of the bigger players that are using what are called one day to expiration options, et cetera. Without getting into too much detail, usually the bond market's right. Yeah. And so what's selling off? Like high yield credit, which really means like junk bonds, lower quality credit. What's catching a bid right now? Treasuries, right? Like longer dated treasuries, or at least they're starting to. So we think that like credit spreads are going to widen. The stock market's going to puke aggressively, most likely as it normally does. There's going to be a wave of defaults.
Is that 20% or more? Puke aggressively?
I mean, we don't. We actually don't do price targets here, believe it or not. But like what's a crash? It's usually like 20% or so. And like, by the way, you can make an argument we've already crashed, like peak to trough in some cases. But I
was just trying to get some clarification on what that puke aggressively kind of would mean. So 20% or more, okay.
Risk. That famous line, right? Like, risk happens slowly and then all at once. And so, these are the weeks where you're down 15% on the week, when like everything's printing down 5-6% together, and the banks are leading the way. Because credit's getting worse, and that's their business, right? Like those are the tells. I think like to answer the question, it's an interesting time to be short. I actually have more short recommendations, even in real estate, which like should be safer, at least theoretically. I would just advocate patience by folks. There's this thought that like things are cheap. I don't think things are cheap at all. Whatever cheap means, like cheap is kind of like an opinion, not a fact. And like the facts are the Fed is pulling out a tremendous amount of liquidity. Rates are high and probably not falling as aggressively as they need to. The consumer is not in good shape. We vehemently disagree with that. Credit card balances are at like all-time highs, and by the way, so are the rates at which they're being charged. It's a very, very concerning kind of macro setup, and if you can't go short, be cautious, be patient. Build a war chest of like dry powder or cash to deploy, because we think things are going to get interesting. Probably like around the middle of this year.
Yeah, I mean, that kind of coincides with a lot of thinking, including my own. We know that typically it takes 12 to 18 months to see the effects of these rate hikes. And so kind of to the point that you made earlier, the Fed has gone on one of the fastest rate hiking cycles we've seen in at least over 5 decades. And we're in now the 13th month. So we're basically 1 month into that 12 to 18 month period. So the end of the summer kind of puts us like right there in that dead zone. And to your point, you start looking at all these other indicators that are out there, and it certainly looks troubling ahead.
It does, and also something that gets lost is it's not just the absolute level of rates; it's the pace at which they were increased. So, like if you look at the rate of change of rate increase, it was literally a straight line up, and I think if you kind of drew a like for like comparison. The last tightening cycle, Powell and team probably tightened 4 or 5 times faster than the prior cycle, and like that means 2 things. A, it's going to be a more severe impact, but also it's going to come quicker and faster and harder. So like maybe if the traditional cycle is 12 to 18 months, like you think about kind of the front end of that, right? And we just think it like warrants a good deal of caution and not excessive risk taking.
From a macro standpoint, today more than ever, probably, I think you have to take into the geopolitical picture, because it's not just the United States operating on its own anymore, right? Really, we're kind of having to deal with these geopolitical forces, including, potentially central banks buying less treasuries, et cetera, dollar and less demand, obviously fighting wars on now potentially multiple continents. That's highly inflationary. You have the decentralization of supply chains and things like that. So those are massively inflationary. But just if we look at just the macroeconomic picture, even in the United States, to your point, you said you think they'll probably hold rates higher for longer. They said they would do that until they break something. Powell said he's okay breaking something because they have the tools to rebuild them. So we kind of know his thought process. However, the Fed is broke now. The Fed is putting massive losses off the books. The Treasury is now broke. The Treasury it had to borrow almost $1 trillion in Q1 this year. The banks are now broke. And so at some point there is this constraint that they hit upon, right? And so the Fed can't even cover the interest and the mandatory payments on its books. The Treasury. And so at some point there's sort of like there's only there's 2 ways out, and they're both kind of 2 sides of the same coin. Default either through deflationary default or inflationary default, right? That's the coin. So
nominal or real, right?
Nominal or real, exactly. So we don't know maybe what happens in the next 12 to 24 months, but it seems like we kind of know where we'll be 3 to 5 years from now. I don't know if you would kind of agree with that.
Yeah, and by the way, that has implications for real estate too, right? So there's going to be a time to get long some of the more like irreplaceable kind of mission critical real estate sectors. But like one of our longest, just at Hedgeye broadly, and we kind of go across like everywhere across all asset classes. We're pounding the table pretty hard on gold right now. I'm personally a Bitcoiner. I own both Bitcoin and gold. Bitcoin behave market-wise, we can have that discussion about what it's going to be, but it behaves a little bit differently than gold from a volatility perspective right now. And so typically gold is a safer bet earlier, but Bitcoin is the faster horse, as Tudor Jones likes to say. I think we would make a bet that that nominal default is kind of more likely, and that hard assets are hard assets typically front run the Fed turning around and printing a bunch of money to basically paper over the issues that you and I are talking about. So like as a firm, we're pretty long gold, or we're advocating people take a long gold position. And I think like for real estate, it's going to have a similar impact, but it's going to take longer because we have to go through these fits and starts in credit and like the issues the consumer has with paying their own bills, whether it be their apartment rent or whatever. It's going to be choppy along the way. But yeah, I think that's right. And our founder says the same.
Yeah. Yeah, I agree. It's certainly, it's going to be an event that's probably going to be very hard to trade through. So it's about just taking your long positions and trying to be right there. If you're just tuning in, you're listening to the Mark Moss Show. I've been sitting down with Rob Simone. He is from Hedgeye REITs. Check him out at hedgeye.com or at Hedgeye REITs on Twitter. And that's what we got. Thanks so much for listening.